Okay, hello everyone. This is another edition of Beyond the Greeks, the research insights from the Panoptic team. I'm here with Nathan from the Panoptic research team. He's going to talk about a very interesting topic comparing base and mainnet. But first of all, how are you doing today, Nathan?
All right, how are you?
Good. Yeah, the I love your profile pic of the West Virginia. So this is the sports
Yes.
team. What's that mascot?
Yeah, the Mountaineer. Yeah, gotta wear my flag proudly, my alma
Okay.
mater. So,
Is it a Greek reference, perhaps, or not? What's that mascot flag?
no, 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 no. I just don't have any decent pictures of myself. So, the Mountaineer makes a good substitute.
Perfect, perfect. But yeah, so this is today, and we do this every week. We just go over a research topic. Again, I come from academia. Nathan as well has a strong background in academia, and we try to show and display and talk about some feature of options trading, something that is a little bit more involved than the daily trading show which we do, but still allows people to gain some insights as to how market making works, how we actually are thinking about market making here at Panoptic. And yeah, maybe before I share your you share your screen. Any small little small kind of intro to your piece for today, Nathan?
Yeah, it's a companion piece to what I did last time about put wing premia, the volatility risk premium, and just saying how those properties translate from a layer one like Ethereum to a layer two like Base.
Yeah, so we are indeed launching on Base on Thursday, 2 days from now. So we'll probably have some research topics that are specific to Base, smaller block times, lower gas fees. It might change. Actually, I have no idea what's gonna the result will look like, but yeah, it might change the dynamics, or maybe not. Maybe everything stays the same. I'm eager to find out. So let's see what you have here. Yeah, take it away with your presentation, Nathan.
Yeah, as I said, it's really just saying about how these properties translate and digging into why. And to start off, we see that you get incrementally higher premia by selling 10 delta put wings on base versus Ethereum, but not by much. Um, it's 84% annualized versus on base versus 80% on Ethereum. And this is only through 3 months thus far this year, just due to data limitations with base. But as you can see on the right hand side, these they crest around the same time in February. Um, so it tracks pretty similarly with only incremental differences.
And be
And the
interesting.
sum returns are almost exactly the same.
Exactly. I mean, at least these 3 months, there's always a tiny edge to it seems base, which is on the lower side, lower hand side. But yeah, it's minimal. I wouldn't put a lot of weight into it, but it might still be true. But yeah, now it's 3 months as Nathan says. But this is very
Yeah.
interesting. And yeah, I remember the February. This is selling puts, which is kind of inherently bullish. You are selling puts. We just look at the premium again, still 80% annualized premium is pretty good. But yes, the volatility we've seen in February does show in a higher fees return that month, which is kind of cool.
Yes. And that leads me into the next slide with why you see these higher returns in February. Um, which is that on both chains, there's a spike in IV in February. It's more noticeable on base than Ethereum. There's a higher prevailing IV on base. But in February on Ethereum, with the Uniswap IV, it crosses over the 200 annualized level three separate times. High has the highest mean level, whereas on base it crosses the 800 threshold. So hence the higher returns. I can't remember offhand if there were any external catalysts in February other
Yeah,
than just general market volatility.
I had a quick look.
Uh,
at least this one is when we went from 3,200 down to 2,600 or
Yeah.
2,500. We'd be happy to have this price now, but it was very, very sudden for sure. And yeah, at least, so what we're showing on the top side is the instantaneous IV that is given a trade, given a certain price impact,
Mm.
and some liquidity. What is the implied volatility of that trade? So it does track the trade by trade. We do see this huge spike, 800%. It is very interesting to me. Might be moving into a range where there's no liquidity. And then we don't necessarily see as big of a spike in March, mid March, maybe. Seems like the ETH one is higher too. So
Yeah, you see the biggest spike on Ethereum in March, but oddly enough, the higher mean level was actually during February because it crosses that 200 threshold several times. And this really got me to thinking. You see this spikiness in both IVs. You know, I mentioned last time about JIT, just-in-time liquidity providers, and how much that contributes to that spikiness and how much it contributes to the on-chain VRP or volatility risk premium. And what I started to hone in on, you know, these um, so far we're seeing that from Ethereum to base, these properties translate quite well. And it got me to thinking on two specific factors as to why. One of them being um, incomplete markets, which translate on both chains. And what I mean by incomplete markets is not being able to hedge away all of your risk completely. And that's true for any market, but especially within the confines of, say, Uniswap. We keep saying over and over and over again that LPs are selling options and you need a platform. I misspoke last time and said you have to buy options on Uniswap. Well, that's not possible. You need Panoptic. You have to buy options on a platform like Panoptic to round out the picture. So really, when you view just-in-time liquidity providers through this situational lens of when there's a heightened volatility risk premia, they ride that wave and sell super short-term perpetual put options and then absorb the price impact and the IV spikes down after they've depressed the IV by selling all these options. There's really no offsetting flow to accommodate um, pent up or latent demand. Um, so that adds to the on-chain VRP, as I'm calling it, or on-chain volatility risk premium. It's like you have these idiosyncratic factors. The volatility risk premium exists in all options markets, be it TradFi, DeFi, CeFi, on-chain or off. But you have these specific structural quirks that I think are playing more of a role um, when we talk about the context of Uniswap because you have that intrinsic optionality. And what I think would happen with the insertion of panoptic volumes and flow um, is that it would actually steady the tide somewhat, stem the tide, and and this is a broader misconception with derivatives in general, going back to the doom loop piece. Um, it actually would help stabilize volatility in the underlying pools, not accentuate it. Um, so that's one uh, factor that applies on both chains that I see contributing to it. And then part and parcel as a component of that are jumps. Now, jumps exist in any asset market and can't be hedged away completely. So I guess all markets are rendered incomplete in that sense. But like I said, you have this inherent asymmetry within an AMM like Uniswap. So that makes them especially hard to hedge away because it's incomplete by design. And then you have these jumps on top of it. So now these are price jumps within the ETH USDC 5 bips pool. They apply to the 30 bips pool as well. This is on a piece you did, or from a piece you did whether ETH is governed by geometric Brownian motion. But you see this play into the IV as well, I think.
Yeah, exactly. I mean, this now that I look at it again, it's a very interesting piece. But yes, the models, what you normally base your options pricing on, is assuming some type of Gaussian distribution, which is that
Mm,
green dotted line, which doesn't match at all the data points, which are the blue dots. And it's not even exponential; it's only a power law, and that power law distribution is problematic in many ways, but it's not at all
mm,
what options pricing is using. So you have the smile, the different kind of volatility, smirk or smile that tries to compensate for that, but in reality, yeah, maybe we need to rewrite all of the Black-Scholes model with using a power law distributed time step, block by block, how
yeah.
much it moves, as opposed to a normal distribution. And again, the Black Swan events that says it's once in a 10,000 year event, it's because you use the green line, which goes to zero very quickly. But in reality, these much larger swaps or much more larger jumps are kind of frequent and kind of more way more expected than you would get from Black Shows.
Yeah, and to emphasize, like with the power law, it's extremely fat-tailed.
Oh, I would
So,
actually be interested. This has like a block time component, so there is certainly a limit in mainnet because blocks are 12 seconds. You may have a lot of price move in a relatively long amount of time. I'd be interested to look. Maybe I'll do it as well, but look at this chart for base because presumably this one is a bit more
mm,
continuous, shorter block times. It may smoothen out and have shorter tails, but yeah, that's another interesting one.
yeah, yeah. Yeah, and I wanted to transition because I thought you contextualized it well with JIT providers. These are tweets from one's a little while ago, but one exchange you had on Twitter was about contextualizing JIT liquidity is a finder's fee for an OTC trade. And it begs the question, okay, what if there's no other venue for a token other than Uniswap? Um, So once again, you have this asymmetry, and it's really a feature, not a bug. And that leads me to the second tweet, which is you talk about like all these optimizations recently within the market, trying to find product market fit within the DeFi space in terms of minimizing losses with AMMs, be it MEV, LVR, JET, or JIT. And really, with Panoptic, you turn it on its head and maximize profits. Like these aren't necessarily variables that can be controlled. You just need to know how to capitalize on them. That's what I was talking about with the on chain specific volatility risk premium. You're going to see volatility risk premia in any options market. There's going to be added convexity in the tails. That's just the way it works in these deep out of the money options because they're more convex to moves and volatility. But or convex with respect to volatility. But these factors contribute to it when you're dealing with a market like Uniswap, and people need to think more about how can we use this to our advantage rather than contain it and optimize in a super convoluted way our hyper specific AMM design, if that makes sense.
Yeah, I mean, yeah, very true. And I think the at least what Panoptic tries to do is to embrace the limitations a bit more and not add other mechanisms on top. But yeah, the JIT reason we see JIT just in time liquidity is because there's a need for it, and might as well embrace it than trying to get rid of it. What we see again, if you don't mind going back a few slides, the
Yeah.
JIT or the just in time liquidity providers are repressing the IV, and it might not be obvious, but on the top left side, there's huge block duration of one block dips in IV. That's because big trade came through, someone added a bunch of liquidity just in time. That meant that overall the price did not move as much as expected, and that's why you have these dips. So the you could even think that the just in time liquidity providers are underselling what they should
Mm,
get because the IV that they get at this specific trade is, I mean, multiples down, like two or three times lower than what it was if it was a shorter trade or smaller size trade, one block ago type of thing.
Yeah, and as you've emphasized many times, in the grand scheme of things, like the percentage of volumes, just-in-time liquidity is minimal, but it is situationally prevalent. If there's an external macro catalyst that uh, causes IV to elevate, they're going to move in and sell and absorb that price impact. Um, Now, what's interesting though, like I said, with complete market completeness is whether, you're seeing the dampened overall volatility levels, IV levels on Ethereum versus base. What I'm hoping and will expect to see, Panoptic's volumes grow to be ample enough and we round out the picture for that to be smoothed out because we've already been operating on Ethereum. Maybe we see the same effect on base over time to
Yeah,
where
yeah,
the IV is smoother.
exactly. Yeah, and then we could also get a glimpse of that on the IV on base. But yeah, this is uh, yeah, very cool. Again, the maybe this is a signal or maybe not, but yeah, it does seem that setting option or at least providing liquidity on base has a tiny edge, but at least it's very similar. Might be that the effect of having a bunch of just in liquidity does reduce the overall returns, because you have like a huge block that captures more fees, but then not quite enough as the rest. But yeah, definitely interesting. And yeah, the base ecosystem or any layer two, even if it's a fast chain, I would
Mhm.
expect they have a type of modus operandi that is very similar to one other, and mainnet might be the outlier in the way that it behaves because of its such a long block times.
Yeah. And that, I tied it back into market completeness a lot in the doom loop, this presentation. And that leads me back to how I ended the doom loop presentation. Same question, but it bears asking again, what are you waiting for if you're an LP? Migrate now. As this Venn diagram, I think demonstrates very well the versatility of Panoptic and what you can do repurposing these LP shares, and taking advantage of that intrinsic optionality. I think the options are limitless on Panoptic, no pun intended. Um, with ways you can deploy your capital, and and I know on the left side of that Venn diagram it says spot trading. Well, selling puts, I guess, is the overlap, but really, I guess in principle, Uniswap is for spot trading, but it's just an incomplete options market. And that's where you see the spikiness in IV. That's where you have these immutable features like an MEV, an LVR, or a JIT. And that's where Panoptic can really harness and repurpose those immutable characteristics to your advantage rather than the over convoluted nature of these AMM designs, trying to mitigate them. You just ride the wave of volatility. And so it's
Exactly.
really the easier, simpler approach.
Exactly. And then yeah, I think the we have something cooking up, and it's going to be launched after we do the base deployment. But yeah, we'll have a migrator workflow. We'll have a position builder that can take any LP now, and then we show them exactly what their positions would look like on Panoptic, but also how their returns will be impacted. But yeah, I think the as you say, the versatility of options and the freedom to manage risk and not just kind of increase returns is very important. And yeah, the if you're LPing in pure Uniswap, you're missing the toolkit. You have a Swiss Army knife that just has one tool. Maybe it's a screwdriver, not the one you want. What we can do with
Yeah,
options is much more broad.
because really the overarching crux of this presentation is you look in a layer one and layer two, and the features are essentially the same. I mean, there's incremental differences, but at least in the case of Base and Ethereum, it's like the rationale, the line of reasoning you would use is the same. You're still combating the same quirks. So Um, so you're still battling the same asymmetry. So why not turn it on its head?
Yeah, exactly. And you get paid for it. You have your passive liquidity deposits earning fees while you sleep. This is also another one. But yeah,
Yep.
very cool. And then was there another slide, I guess, Nathan, or it's
No, this was it actually.
okay, perfect. So I love this piece. We do compare, and we will do a lot more of those where we compare market structures in Ethereum land, in the layer two land. It's again, the faster the chain, I'm sure the more closer you would expect the behavior to be smoother, maybe a bit less jittery, but overall. It seems that it's all doing pretty much the same thing, whether it's a 12-second time scale or a zero point 0.5 second time scale, which is kind of interesting. So, all right. Thanks so much, Nathan. This was great. Yeah, looking forward to the next piece. I don't know if it's going to be on base as well, but yeah, I'm really excited to explore this a lot more. So thanks a lot.
Thank you.
All right. So that I think that concludes the research insight portion beyond degrees of the Panoptic team with the Panoptic research team. Yes, stay tuned. Wednesday we'll have options hour. We'll have Izzy, which is going to be learning about how to be a Panoptic trader, starting from being a Uniswap LP. So again, the same way we taught Rosalie how to break out of that meme coin trading shell and the end of go out and be a experienced options trader. We hope to do the same thing with Izzy here from the team that was an LP in Uniswap and now will benefit very well from using Panoptic. So stay tuned. Wednesday is when we first have this. We have also a repeat on Friday. But yeah, I think that's it. Thanks so much, everyone, and have a good rest of the day.